This is the most bearish piece yet, and it just came out from UBS. I'm not looking for bear pieces. I've covered plenty of bull pieces here, but I'll tell you, this is scary. Look at this very closely. Market Internal Weekly, UBS. I am turning tactically bearish the next 2 months, expecting at least a 10% decline, looking for hedges in various different areas. We're going to be covering which hedges they like. And boy, oh boy, this is a really big piece because they talk about how some things have gotten so bad in the market that we haven't been positioned like this since 6 years, since COVID, since 2008 in some cases. This is crazy. So let's go through this and try to add some balance to this. A few things to know. Number one, tonight at 6 p.m., folks, 6 p.m. tonight, what are you going to get? You're going to get the debate between Harris and Trump. This is obviously going to be a big deal, mostly because if Donald Trump is deemed to potentially win this debate, people think markets and crypto might go up, vice versa, for Harris potentially winning the debate. I'll be covering it live. Next, tomorrow at 5:30 a.m. California time, all these times California time, we get the CPI report, and then 5:30 a.m. on Thursday, we're going to get the PPI report. These are really going to be important for the direction of treasury yields, for the direction of investments related to those, mortgages, you name it. A lot happens within the next 48 hours here, and that's why it's really important you mark your calendar for 6 p.m. tonight, and then you could also mark your calendar for 6 p.m. on Thursday, because folks, you've been asking for it. We're adding a flash sale to cover this wild period of time. It's going to just be until 6 p.m. on Thursday, now to 6 p.m. on Thursday. Flash sale for the courses on building your wealth over at meetkevin.com. Those will include the Stocks and Psychology of Money group, where I'm planning to increase a one trade that I have going on right now. That's a $1.5 million trade to over $2, maybe even $3 million in size. It is a huge trade. And we're going to do a full course member live stream on why we're making that trade tomorrow morning. All right, so here we go. Over the last 2 weeks, market internals have deteriorated to be the worst year to date. Current condition is also the most vulnerable in 6 years, which means any external shock or slight disappointment of the data could trigger a large unwind. Notice how they're saying slight disappointment, large unwind. Folks, this is the opposite of when people think, oh, a lot of people have money to buy the dip. You're going to see right here, people are selling the dip. They're not buying the dip. And you're going to see everything about retail flows and a lot of warnings here. It's wild. It's actually one of the reasons why I think the trade that I have that's $1.5 million in value now, it's already up this trade. It's been up. I've just added to it again. But I might go as far as maybe doubling the trade that I'm doing. The reason I might do that is because I think this trade works whether we have a recession, no recession, or some form of shock collapse. And boy, oh boy, this piece right here will make you want to consider that trade. Now, evaluate it for your own portfolio. This video is not financial advice. You could come to the course member live stream tomorrow. We'll talk all about it. That's all tomorrow's course member live stream is going to be dedicated to. Why I would put potentially $1.5 to $3 million on one trade. It's going to be wild. Okay, take a look at this. I'm tactically bearish for the next 2 months before the election on the back of the 2-month intraday recovery score collapse to a 6-year low. The intraday recovery scores, just so you know, recovery scores are just a fancy way of saying, hey, we have an algorithm where we can weigh how much we think after a market sell-off, the market is likely to recover based on volatility, sentiment, flows, and a whole host of other factors. They're saying they have not seen recovery scores as low as this in 6 years, which takes you back to like the, bond crisis of 2018, even worse than what you saw during COVID. Take a look at this. This call is more bearish than my email on Tuesday. On Tuesday, I suggested a just-in-case hedge of macro events given neutral recovery score. This was last Tuesday. They just released this note. I got it last night here. And I expect a choppy market. Today, suggested a tail hedge due to the 2-month recovery score collapse, as I expect the S&P 500 could be minus 10% peak, or minus 8% from here within 1 month, and negative 15%, so double that within 2 months. After I read this note last night, I think I spent probably around 2 hours trying to evaluate what the best hedges would be for this. And I actually don't like their hedges. Their hedges are IWM, XLF, and HYG. I actually think I have a better hedge that can last longer than these and work whether this person is right or wrong. And that's why I'm going so bullish on it. Obviously, the thing about me is I just put my money where my mouth is. And if you want to see what my perspective is and why it is, use the flash sale, meetkevin.com. You know how to do it. You pay once, you get lifetime access forever to all the course member live streams ever. This is not a long-term view unless the 4-month recovery score makes a decisive shift. So in other words, the 4-month recovery score after the election basically saying, hey, maybe we could still be okay. So they're essentially saying, hey, 4 months out, neutral. 2 months out, really bearish, which aligns with my desire to hedge between now and then buy the dip before the election if we get unwindings in recessionary data. There's a lot of recessionary data out there, and it's just getting worse. It's not getting better. Okay, so what else do we have here? Even a slight disappointment of any upcoming economic releases could trigger a large unwind. On no news events, moderate volume selling could continue in the market. My current preferred hedges are IWM, XLF, and HYG downside, so in other words, short. XLF and HYG option premiums are screened as cheap. Basically, they're saying here, like, not a lot of people are shorting them right now, maybe because IWM had a short squeeze. It had a little run up there, which, people like Tom Lee thought was fundamental, and it was really just a short squeeze, and those actually make for a good hedge right now. Financials, by the way, financials just tanked today after the Basel III release, but financials were actually above their 50-day moving average, which suggests near-term upside could be limited. How funny, because they literally just tanked like 5 to 7%, like JP Morgan even tanked. But anyway, the financial sector is also the least hedged across all 11 sectors. Yikes. Take a look at this. Intraday recovery scores. The recent rally was associated with a constant sell the rally profit taking and a lack of buy the dip flow, an indication that investors are losing conviction in the market. Very bad going into a volatile September and October in election season. Intraday recovery score fell by 14% in the 1 month on August 29th to negative 17% on the 4 month, again being neutral. Today, the 2-month score fell further to negative 22%. So in other words, the recovery score is terrible here at a 6-year low. They say that the risk asymmetry has now increased to where you only need 6 sell the rally days to turn the entire market bearish. And you need 12 days of buy the dip to turn the market bullish. So in other words, much more negative skew here. It might not take a lot to push this market over the edge. To make this condition even more rare, the recent sharp confidence collapse was so rare in history that it's only happened 15 times since 2000 and only 9 times in the 25 years when the recovery score collapse was coupled with an S&P 500 rally. So in other words, out of those 15 times, only 9 of them occurred when you had a recovery in the S&P 500 and the recovery was low. In other words, this is probably not a built-to-last recovery we're seeing in the NASDAQ or the S&P 500. This is very bearish. In all of 7 out of 7 times since June of 2001, the S&P 500 fell an average of 5.2% within 1 month and 8.1% within 3 months, and they give the ranges here, pretty much all down on the ranges. So far, the S&P 500 is only down 1.6% since 8/29 when this indication was triggered. Investors are on the edge and are vulnerable to any bad news. Given the S&P 500 up 18% all the way to 830, many investors had a good year and are ready to cut some risk in the 2 months before the election. This is why sentiment hasn't turned bearish, but trading behavior has been cautious. Any disappointment in the upcoming economic releases could accelerate the modest profit-taking behavior and the massive unwind. Retail market-making flow has turned to bad in the last 2 weeks. This implies that in the case of any market sell-off, I do not expect retail investors to buy the dip. They may actually instead sell the dip. Selling was all in single stocks, with the most extreme being in consumer staples over the last 12 days of August. Current retail sell flow is almost identical to the 3-week sell flow that we saw in July and early August. And retail market making data suggests that sell to dip in the last 5 of 10 days was associated with the S&P 500 down 13% on average in the future. In addition to that, we hit peak seasonality for corporate buybacks now, and by the 3rd week of September, you hit a blackout again where you're going to stop getting corporate buybacks at all until October earnings for Q3. This means the market is expected to lose a major buyer of last resort in the 3rd week of September. So in other words, you've kind of got a little heads up warning here that probably between 9/21 to maybe 10/30, right, October 30th, you've got some major potential oopsie-doopsies ahead of you you might want to prepare for. Again, I'm preparing with multi-million dollars worth of bets that I think will do well, whether we just slowly trend down or we trade sideways, the Fed moves slowly, or we have a dirty recession. I think I found a way to play this. We'll have the full, full explanation in the course member live stream tomorrow. That'll be right around 7:15, 7:30 California time in the morning. After we get the CPI data, we'll cover this in detail, exactly what I think the upside and downside risks are and how to minimize some of those downside risks while maximizing the upside. And remember, once you join once, you get access for life. So even if you just want to look and go, what's he seeing out there? And you look at it and you go, nah, I'm going to do the opposite. That's fine. You get access for life. I can't make any guarantees, obviously, you know that. I also expect risk appetite to collapse or appetite collapse to dominate market internals. So in other words, if you get a sell-off, you're going to see the sell-off potentially everywhere is what they're suggesting. They see Commodity and Trading Association individuals planning to sell within the next few weeks. I don't really trust that data. I feel like they always sort of flip-flop anyway, so I didn't add any highlights here. We got a lot of charts and data that go on in the next, frankly, 30 pages of this. But that's the overall big warning. And again, they're telling you worst data signs that we have seen for the market since 2018. And the market had a little oopsie-doopsie in 2018. Now, that doesn't mean you're going to have red every single day, and it doesn't mean it's time to panic. Look, the reality is, in the long run, investing in a diversified portfolio like VOO with some bonds, with some real estate, is probably a fantastic way to wealth. You could even get some crypto in there. If you really want somebody to analyze your personal situation, though, do consider going to get actual licensed financial advice from my team of financial advisors. They get my advice in terms of how to work with you, and so we'll be reviewing your scenario together. So I'll actually be looking at every one of our client scenarios to make sure that my fingers and my touch has been on it. And we want to try to say, hey, how can we position you to make sure whether you're in VOO and bonds, how can we expose you to some real estate? Maybe you're all real estate, how can we get you exposed to some buy the dip opportunities in stocks? You're all bonds, how can we get you into real estate and stocks? You want to throw some crypto in there, you need a new car, need a new house, need to renovate a property, need help with this. Or separately need business consulting. Go to stockhack.com. Check it out, sign up. That's obviously separate from the courses and the trading that I do that you can find over at meetkevin.com. But stockhack.com is a great option. This terrible bear piece, sorry to say, there's no sugarcoating this one. Thanks so much for watching. We'll see you in the next one. Goodbye and good luck.
Advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.